Hello and welcome to the tax roundup for December. And it's not so much a wind down period, but a mad dash towards a point of no return for most advisors. And there's been so much going on, it's not a surprise, including those wide-ranging reforms to superannuation that passed through Parliament and are now law. If you're a member of Knowledge Shop and go to the Knowledge Bank, you can download a client letter addressing the reforms and also a couple of newsletter updates and articles from the Knowledge Base. Now, this month inside the Tax Roundup, we're looking at public trading trusts and those transitional rules. We're taking you through trust arrangements that the ATO really don't like. Once again, must be coming up to the holiday season, there's updated guidance from the ATO on holiday homes, and a really interesting case that Michael is going to address that looks at what happens when you've got an overseas company, an overseas board, and how do they still get caught by Australian tax. But first up, we've got Bradley Beer from BMT Tax Depreciation. That's got our tip of the month, and this time for older homes to get some deductions for clients that you didn't think you potentially could get. Across to you, Brad.
So old properties still get depreciation deductions, and you'd actually be quite surprised at how much they often do get. So take a situation with your client bought a house like this one here, say, that was built in the 1950s. We can also see it's got a fancy old kitchen in that property as well. And in the first year when looking at this, there's been a few little renovations on this property. The deductions are just under $6,000. Now that's still quite substantial deductions given that it's an old property. In the first 5 years, this property's got over $24,000 in deductions, and over the life of these deductions, about $115,000. Now the way that we find these deductions is that we go into this property built into the 1950s after your client has bought it, and there's been some works done so we get some of that Division 43 allowance, even though the original Division 43 is all run out. Then after that, we're looking at the condition and the value of all the plant and equipment items, and we're able to put a value on these things at the time of your client's purchase. They come up, we apply the depreciation, and therein comes the numbers. You'd be quite surprised to know that about just over 20%, 22% of the properties we actually do are built prior to 1987, which is that important Division 43 date for residential property. And actually, only just over 20% or 21% of our properties are actually new properties that we prepare a depreciation schedule on across our whole portfolio of deductions that we've actually done over the last 18 years.
Now from the ATO, Rae is going to take you through those transitional rules for public trading trusts.
If you have clients that have trusts that have been treated like public trading trusts in the past and therefore were taxed like companies, this is just a reminder regarding the transitional provisions that now apply. So up until the 30th of June 2016, they were taxed like companies. They would have lodged a company tax return. They would have maintained a franking account with all the franking credits that they could then pass out to the unit holders. Now, obviously, they are taxed like trusts, not like companies. So that trust would now have to get a new tax file number and a new ABN so that the 2017 filing onwards would have correct records as a trust, whereas up to 2016 it was reflected as a company. Now, if payments are being made now, after the 30th of June 2016, that relate to that earlier period where that trust was treated like a company, those payments still get added to the franking account, and the credits in that franking account can be used and passed out, but only up until the 30th of June 2018. So a timely reminder to just look at what's in the franking account, what might still be coming in relation to a period up to 2016, and then how can they be passed out beneficially to those members.
Now Michael is going to take you through that taxpayer alert on aggressive trust arrangements.
The ATO is taking another step at looking a bit deeper into certain trust arrangements where the ATO believes that there's a manipulation of the way the tax rules happen to work. Now, some of you may remember that a number of years ago the ATO established a trusts task force specifically aimed at looking into the way trusts were used potentially in an inappropriate way within the tax system. And the ATO has released now a taxpayer alert 2016/12, which looks at some of the issues the ATO is a little bit concerned about flowing out of that trusts task force work. Now, basically what the ATO is looking at is situations where people have taken the economic benefit that might be reflected in the taxable income of a trust but then excluded that from the distributable income of the trust. And let me give you an example of a typical scenario that the ATO is looking at the moment. So let's say we have a trust which has taxable income of $1 million, and the trust deed gives the trustee some discretion as to how to determine trust income for the year. So the trustee makes a resolution to say that this year trust income will be 30% of whatever the taxable income of the trust is. So the trust income for the year, the distributable income that's available to be distributed to the income beneficiaries, is $300,000. So the trustee then appoints that trust income, the $300,000, to a corporate beneficiary. Under the proportionate approach within the tax system, the corporate beneficiary, being entitled to 100% of the trust income, is taxed on 100% of the taxable income. Taxable income, $1 million, tax payable on that at the general corporate tax rate is $300,000. The trust gives the $300,000 of income that is owed to the company, which allows it to then pay its corporate tax liability. So that's the company sorted out. There's still $700,000 worth of value in the trust, which is now basically treated as trust capital. The trustee then makes separate resolutions to distribute or appoint that trust capital to other beneficiaries, maybe individuals within the broader family group. So even though these individuals are receiving $700,000 odd worth of value, cash from the trust, they're not paying any tax on it, because under the proportionate approach, it's all taxed to the company at the 30% company tax rate. Now, sometimes you do get these mismatches between trust income and taxable income, just simply because of the way the tax rules work. Some things might be assessable or deductible, whereas maybe for normal trust principles, you may not take those into account. What the ATO is more concerned about is where there's a deliberate attempt to create a mismatch between those things, and that then leads to what, in some cases, could be a very significant tax benefit to people within the group. So it's just one example of the sorts of thing the ATO is looking at. Certainly not limited to that, but it's just one example. What the ATO is doing is basically putting a warning out there to say, look, we know this sort of stuff is going on. We're not necessarily happy with it, and these are the sorts of things that we'll be looking at. And there's a number of ways that the ATO might choose to attack those types of arrangements to recover a greater level of tax on those. The ATO is also kind of using its kind of data matching and other powers to identify tax agents, tax practitioners, who look like they might be selling or suggesting these types of strategies to their clients. Again, the warning is there for those tax practitioners that the promoter penalty regime could potentially apply to those types of people. Now, obviously it depends on a case-by-case basis whether there is really an issue there, but certainly the ATO is putting the warning out there that, look, they've been looking at trust arrangements for many, many years now. This is just another example of the ATO kind of digging a bit deeper into the use of trusts to create a tax benefit. It's something to be aware of, to keep a bit of an eye out for, and at least be aware and have the conversation with clients that, you know, some of these things, they might work from a tax point of view, but there's a bit of risk there. There's a bit of risk there that they just need to be aware of.
And again from the ATO, Rae is going to take you through their updated guidance on the tax treatment of holiday homes.
Given that everybody's thinking about holidays, and why wouldn't you this time of year, it's important to remember that the ATO have got a focus on people who have holiday homes or rental properties in popular holiday destinations. And it's important to be aware of what the ATO's view on some of these things are to make sure whether you're on the naughty or the nice list. Now, one of the things they are looking at is whether that rental property, or property declared as a rental property, is genuinely a rental property. Has it been used privately by the taxpayer? Has it possibly been, rented out to friends or family members at a less than market rate? That's obviously going to impact the amount of deductions that can be claimed against that rental income. Other things the tax office are looking at is what kind of restrictions are being put around the tenants who might be using that property. Is it perhaps something unusual or restricted that means it's not genuinely available for rent? So for example, if you have a holiday home in a popular destination for families, and you say that the tenants cannot have any children in there, that might be considered by the ATO to not be quite genuinely a rental because there's an unreasonable restriction being put on. So keep in mind, if you do have a rental property in a holiday destination, is it genuinely available for rent? What evidence do you have to support that? Should the ATO come knocking on the door? Because it definitely is a current area of focus for the tax office. They have issued a guide about this before. They've updated it. There's plenty of examples in there. It's all available through the link on the tax roundup. So just make sure you're aware of what the ATO will be looking at.
Now across to Michael for that case of a company incorporated overseas but still caught by Australian tax law.
Now this month, interestingly, we've had a couple of cases, actually tax-related cases, go through the High Court, and we're going to pick up on one of those this time around, which is the Bywater Investments case. This is a case that looked at whether 4 companies should be treated as residents of Australia for tax purposes, which would then expose worldwide income to Australian taxation. Now, brief summary of the facts. We had these 4 companies that were all incorporated overseas. The majority of the directors of the companies were non-residents, and the majority of the board meetings were held outside Australia as well. This really came down to the residency test. Now, these companies weren't incorporated in Australia, so they weren't automatically treated as residents under the incorporation test. When a company is not incorporated in Australia, we need to look at whether the company carries on business in Australia. If so, we then have to take the next step to look at where its central management control is located, or who controls the voting power. We're looking at shareholders and their residency status. Now, this particular case, by the time it got to the High Court, really the main focus was just where was the central management and control of these companies. Now, the High Court looked at kind of the long line of cases that have looked into this issue and said, look, in general, the central management control of a company will be where the board holds their meetings and make their decisions around the company's operations. However, that's only a general rule of thumb, and that is based on the fact or the assumption that the board are actually exercising genuine decision-making power at those meetings. If it appears that the board has actually handed over their decision-making power to someone else, well then the fact that they may happen to hold a board meeting in a particular location and effectively rubber stamp decisions that someone else has already made won't be enough to show that that is where the central management control is located. Now, in this particular situation, the court was satisfied that the board had actually handed over their decision-making power to an external party. The external party being an accountant based in Sydney. Those decisions around the operations of the company were made in Australia. Therefore, High Court was satisfied that the central management control was actually really in Australia. Therefore, these companies were treated as Australian residents and exposed to Australian tax on worldwide income, not just their Australian sourced income. Now, one of the other issues that was picked up by the High Court was, well, some of these companies were kind of located or had been incorporated anyway in countries that had double tax agreements with Australia. Now, the way often double tax agreements work is that if a company is a resident of both of those countries, the relevant countries, there's tiebreaker tests often within the treaties. So if you had a company that's resident in 2 countries, you work through the tiebreaker test and say, well, for the purpose of applying the rest of the provisions within that treaty, where would that company be deemed to be a resident? Normally, the double tax agreements look at where the effective place of management is situated for the companies. Again, the High Court said, well, central management control was Australia. Looking at the similar sorts of factors, they were also quite satisfied that effective management was in Australia as well. So the double tax agreements basically provided them with no assistance in terms of trying to escape Australian taxation on their foreign sourced income. So big win for the Commissioner in this case. These 4 companies all treated as residents of Australia because of central management control, real decision-making power being exercised in Australia despite the look or the appearance of maybe board meetings being carried on somewhere else. It was the substance, again, substance over form. The substance of this situation was decisions made here. So interesting decision again from the High Court. This has been through the layers. Clearly it's not going to go much further than this. But again, a bit of a warning just to, yes, of course, have your board meetings maybe in the place where you think central management might be located. But that in itself is not enough. You do sometimes just need to dig a little bit deeper to look really behind kind of the face of something, to look at the real substance.
And that's the tax roundup for December and also for this year. We wish you and your team a fantastic Christmas. Remember, if you're not a member of Knowledge Shop yet, it's not too late. Give Julie a call on 1800 800 232 and just find out what we can do both now and in the new year for your team to keep you on top of all those changes coming through. Speak to you soon.